recording, so I'm going to call to order the February 18th, 2026 meeting of the trustees of trust funds. And before we proceed with our usual business, I would like to do two things. First, I want to welcome our new trustee, Christopher Clement Sr. Chris officially became a member of this as of about 9:35 last night when the City Council approved his application, and he was sworn in this morning. Would you like to say anything to our viewers in TV land, because this is going to be recorded for posterity?
Well, thank you, and it's an honor to be here to serve, so I'm looking forward to it, so thank you very much.
Welcome.
Thank you.
Great. And then secondly, Dana, I just want to take a matter of personal privilege to thank you for your service as a trustee. You've been, we've lost your face, Dana, but yeah. Okay. Oh, here we go. So you've been a trustee for 15 years. 14 of those I've served with you. And I've also, as you know, served on another city committee with you, the Economic Development Committee, for a number of years. And during that period of time, I've really come to appreciate what you have brought to the table on behalf of the citizens of Portsmouth. When I think about our service together, I really think that you have the qualities that really make a outstanding servant of the people. You, and particularly in the case of the trustees, you have financial acumen, you have common sense, and you have a professional demeanor. And I think those have served us all very well as a trustee for the last 15 years. And so I want to thank you for your service on behalf of not only myself and the other trustees, but for the citizens of Portsmouth who obviously can't be here today. And with that, I know you want to say a couple words, and I welcome you to speak.
Okay. Well, Tom, thank you. You're going to give me a big head this morning for those very generous comments. Obviously, today's bittersweet for me. It's been 15 years I served as a trustee, and it's been really a privilege to serve alongside yourself and Peter and the trustees who came before us. We're a small but mighty group, and it's been really exciting to see the city trust funds grow to, I think we're on 30 million, give or take. And that's really due to the generosity of our community. It's a real testament to the city of Portsmouth and the people who live here and want to make the city a better place every day. I cannot leave without giving my personal thanks to each of you. Judy, you have been a real stalwart for this committee. When Peter, oh God, his name just...
Torrey.
Peter Torrey.
Peter Torrey, thank you. Oh, how could I forget? So embarrassing. When Peter Torrey moved on from his position as administrator for the trustees, frankly, I was quite nervous because Peter did a fabulous job. And you stepped in and everything just continued seamlessly. You have been a real source of consistency for the trustees, so thank you for all your service. Peter, it's been great serving alongside you. I will come back every year to get my political voting card recommendation from you. I can't miss that. And Tom, you've made the comments about serving together over the years. You're a magnificent chairman. Your leadership's appreciated, and the only thing I wish going forward is, I'll be more than happy to be your campaign manager for the council, city council. So look forward to that. And Chris, thank you for stepping up to serve. It's a great group. You do great work, and I wish everyone Godspeed going forward, and thank you, and enjoy today's meeting. I'm going to sign off and go play tennis.
Thank you.
Bye, thanks, Dana.
All right, thank you all.
Thank you.
Have a good one.
Stay well.
Bye-bye.
All right. Okay, now we'll proceed with the regular business.
I move we approve the minutes of the previous meeting.
Okay, that's the minutes of the December 18th meeting. Do I hear a second?
Can I approve if I wasn't here?
Well, right now you can just second his motion.
Second, yes.
And I will tell you, I did look at the Robert's Rules of Order, and you do have the right to vote not only to second the approval, but to approve the minutes even though you weren't there, so. Any corrections or comments or suggestions for changes? Hearing none, I'll call the question. All in favor indicate by saying aye,
Aye.
Aye.
and the chair votes aye. All right, first, next item of business is
Mr.
the,
Chairman, I nominate Tom Watson to be chairman for the 2026 calendar year.
okay. I will officially open the nomination period and accept your nomination. Do I hear a second to that?
Second.
Okay, are there any other nominations? Hearing none, I will close the nominations and call for a vote on the motion. All in favor indicate by saying aye.
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 Any opposed? The ayes have it. All right. Next item is a request for funds from the Tommy McCann Trust.
Mr. Chairman, I approve and thank Tom for getting back to us, and he apologizes for the lateness of the letter to be reimbursed, so. And he has another one coming in, which is what we had hoped for when this was set up.
Yeah. For Chris's benefit,
That's $159.
Correct.
Yeah.
yes.
Yeah.
Well, and just so you know, Tommy McCann was Portsmouth, born and raised, and spent his life living here. And when he passed away, he left a significant sum in his will to benefit students of Portsmouth High School who are economically disadvantaged from fully participating in sports at the school. So it's not a scholarship as such, but it was created to assist students who aren't able to fully avail themselves of the sports programs at the school because of their lack of financial resources. And as the request, and so we periodically get these, are not normally a large sum of money. This doesn't cover anything that would normally be covered by the school budget, so it's not meant to be a budget supplement. And so I won't get into the specifics on the individual, but you could see that the request presented by the athletic director was for somebody whose family circumstances were such, so. So Peter has made a motion that we approve this request. Do I hear a second?
Second.
Any further discussion? All in favor indicate by saying aye.
Aye.
And the chair votes aye. Okay, next item is we have received, well, you received two sets of checks. There's several that were received in December and January that were up for consideration at the January meeting that was postponed, and then you have new checks that have come in since that meeting, in primarily end of January, February. They total $19,125, and these relate to a arts project that is being organized by the park, the Public Art Review Committee, and for another sculpture to be placed in Pohanko Park. They are actually, the park is doing the fundraising. Our job is to collect the money and then hold it until it's ready for release. And so I would entertain a motion to accept the checks that we've received as shown in the packet.
So moved.
Okay, any discussion? Hearing none, I will call the question. All in favor indicate by saying aye.
Aye.
The chair votes aye, it's unanimous. Okay, next item is an update on the Horace Haven Metals Fund. In your material is a copy of the court's decree that was issued on February 2nd, approving our non-judicial settlement agreement that reformed the trust. This is really for informational purposes, but by way of a very short summary of what had been a very long process. I don't know if you read the material or not, but so in 1843, a young gentleman in Portsmouth passed away and left a princely sum of $800 to the city to make academic awards for academic excellence. Over the years, the school no longer teaches Greek and Latin and other classics, but no one had seen fit to sort of update the terms of his will and a subsequent arrangement that had modified that in 1862. And so we undertook that process with the legal department and in the Attorney General's office, because they have governance over these type of trust. And ultimately, as the packet indicates, that agreement was submitted for approval by the court and signed off on February 2nd. So what you have here is just for your information only. I
Move we accept and place on file.
Okay, do I hear a second?
Second.
Any further discussion? All in favor indicate by saying aye,
Aye.
and the chair votes aye. For informational purposes, it occurs to me that when we transmit this to the school department, they may actually have, the superintendent may have a copy, but this document gives the school department, at least the principal, a great deal more leeway in making changes in the future, but it does require they have to be adopted as policies as opposed to just ad-libbing as you go. So I have discussed with Jen Smith, perhaps she should do a transmittal letter. And so with your permission, I'll ask her to finalize that for our consideration at the next meeting. In the meantime, we can advise Brittany over at the guidance office that they can issue medals for the CTE program for this year.
I will do that.
Okay, great. All right. The TD folks don't start for another 15 minutes, so we'll proceed with,
To the next item.
yes,
Does anyone need a copy of the scholarships?
Yes.
we need one that we can read.
Yeah.
Chris, are you all set? Or
I am, yeah.
Nathan, I have a copy for you, so you can look along if you want.
So while Judy is distributing that, again, for Chris's benefit, so as you know from the materials we received, we hold and manage a substantial amount of money relating to scholarships. Our process is that we don't decide on the recipients, but on an annual basis, either in January or February, based on the prior year's performance, we will vote on an amount per scholarship that we think we can make available for awards this year without compromising the principal. Almost all these scholarships don't allow us to use the principal for the scholarships. There are some which we call a sort of a sunset type of thing that do that, but they're a very limited number. So our goal today, and I'll ask Judy to take us through this, is to vote on the amount for each scholarship that we can transmit to the school, and when they make their awards in May and June, they'll know how much they can give to each student. So would you like to walk us through this, Judy?
Sure. So I'm going to start with the fourth column. The first column is just the book value of the fund as of 6/30/25 when we filed the MS9 and MS10. The second column is just the percentage of each of those trusts out of the total, so that we know how much each trust contributes into that amount. The third is actually the fair market value of the funds, and that's as of 12/31/25. And then fourth column is the income that was available per the MS9, MS10. And so that's not the principal, that's the income that was basically earned that we can look at paying out from for scholarships for June 2026. So the fifth column is what we awarded in fiscal year 25, so you know how much we gave last year. And then the suggested column, which is the sixth column in blue, is what I'm proposing as an amount to be awarded for the June 26 scholarships. Last year, we awarded $320,950. This year, I'm proposing $389,450, an increase of 2.5% over last year. Anything that's set in the green in that column is actually a set amount, either by the terms of the trust or it's a sunset and we're running it down and then we can spend the principal on that one.
You said it's in blue or it's in green?
Green, and green is the ones that are set.
Yeah.
So we, for example, the Tony Ron scholarship, we're spending that down per the AG's office. We have permission, we're spending it down. I did look at that and make sure, because that is awarded in the second semester, that I took into consideration, made sure we had enough in the balance before I proposed the 10,000. That some students haven't come in yet this year, they're coming in now for it. I wanted to make sure we had enough money to cover it, so we're good. There's actually nothing there that is that big a thing. I did increase significantly, for example, the Portsmouth Community Scholarship for Higher Education. We just have, plenty that we can award, and that's a good generic scholarship that might be able to really help some kids out. So I bumped that one up. So
I have a couple questions.
sure.
I'm looking at the very bottom of the fifth column, and it said last year we awarded 2.32% of the fair market value.
Correct.
Was that the amount we voted to authorize, or was that
Correct.
the actual amount that we spent?
No, that's the authorized amount.
Okay.
That column is what we authorized last year to give out. I'd say that probably we have awarded between 80 and 85% of last year's funds. I still have students coming in. We have several that have deferred, so that I'm tracking that, so that I know that in the fall they've deferred a year, but they still are eligible to get the scholarships, so.
Right. And so this year, we're bumping that up,
By 68,000, I mean, if that's what we want.
by the percentage, we've gone
Correct.
from 2.32 to 2.56.
5.6, correct.
Is that recommendation basically based on last year's performance, or did you think we're at a point where we can annually increase that amount?
I think that you're gonna have to go year to year. I mean, obviously, if we have a very bad year and you don't earn the income, which is what we base it off of for the MS9, MS10, you might have a year where we have to award something less because we don't have. But again, a lot of these awards, I'm not proposing the full amount that's sitting there available. So I try to give a buffer. I don't try to expend everything unless specifically requested by the trust, that you give out $10,000, period.
Okay.
Okay.
The reference to the income available, that's not just interest and dividends, that's also appreciated value? Okay, just want to clarify that for Chris's benefit.
Yeah, thank you.
All right, so I open it up to questions of Judy on her recommendations.
I move that we approve the recommendation.
Second.
Okay, so my question obviously our goal is to maximize the amount we can give out without compromising or putting us in a position where some subsequent year we can't give.
Correct.
Is there any more room to increase that amount?
I mean, obviously, you could increase, you know, if you look at the community funds, I mean, you could increase from, we gave out 7,000, we're going to 15 this year. If you wanted to bump that up to 20, we could do that. I mean, the community scholarships, except for STEM and tech, but the, you know, the first three, if you wanted to bump those up, there's room to bump those up if you are inclined to do that.
Okay, so I when I was looking at this yesterday, you know, I see, for instance, on the demerit, you know, we had income of about 93,000, and we're only giving 60 out of that.
No, you're giving 70.
70 out of that.
Yep.
And again, I guess I'm just, when you advocate for this particular sum, it's because you,
I'm just keeping it relatively conservative, but still trying to give it, you know, a significant enough increase over next year. I just, you know, I mean, it's just one of those things where I just don't want to run into a surprise that.
okay, no, I understand. I'm
Yep.
just, okay, well, there's a motion on the floor, in light of previous comments. Are we, is everybody still comfortable with the recommendations?
Yes, and thank you for the background, it's helpful,
Okay.
yes.
All right, then, I'll call the question. All in favor indicate by saying aye.
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 And the chair votes aye.
Great, thank you very much.
All right, so the next item is the,
5-year rolling average?
well, the Prescott Park. And
Yep.
so, again, for benefit of Chris, the money's held in the Josie Prescott Trust. I'm sure you're aware of the Prescott sisters and their generosity to the city. They're the ones whose inheritance was afforded them the opportunity to buy all the land that became Prescott Park. And then when they had the last passed away, they turned that over to the city with this fund to assist in its maintenance. Long ago, the city went to the AG's office and worked out an agreement. I think in those days, they actually had to go to court that allowed this trust to not be just dispersing income or increases in value, but is issued on a 5-year rolling basis. And as our job is to determine what percentage we will disperse based on the 5-year average in partial payment of the city's budget operating the park. So until 2016, when we had a master plan, the trustees actually operated the park, and on an increasing basis, a little bit each year, we found that we weren't able to meet the operation of the park with the funds, and so the city supplemented it a little bit each year. One year they took on the insurance cost, another year, and so ultimately it was decided that the better thing was to have the park actually operated by Public Works and the city manager instead of having the trustees do it. Our job was to focus on the funds, and then as long as the funds that we dispersed from the trust were in payment of expenses for the operation of the park, not for other parts of the city, that was a better way of doing things. So we receive a budget from the city annually, and then now we'll determine what percentage we want to provide, and then twice a year we'll actually do disbursements after the expenditures have been spent. So, with that, Judy, walk us through your recommendation on our disbursements for this year.
Sure. So starting right at the top, we have, as of 12/31/25, you have your book at cost value of the fund, and then you have your fair market value. Third column over is the percentage of return on each of those categories within that fund, and that information comes from TD. So 3.89 for the cash, and it's actually like a money market that they have through them, and then your fixed funds and then your equity funds, giving an average annual income based on that of a total of $157,329. Then your second area is basically the guidelines for your policy, which is, you know, taking your current year fair market value at year end, okay? And then the next chart is your 5-year rolling average. So this year's 5-year rolling average is $6,638,890. The previous year was $6,259,068. And then down below, we always have the previous 5 years. So you can see the growth of the fund. So it's kind of just an interesting statistic that we keep on the chart. Then from there is down in the bottom section, which is gonna help you determine the amount that you wanna get. So the cap on your policy is 4%, that's the highest. The second column is at last year's percent. Actually, let me go first. The fourth column over is what you approved last year, which was a total of $215,900. And that was at a percentage of your 5-year rolling average of 3.45%. And I've got 4 different scenarios for you. The first column is at the 4% cap, which is the highest amount. The second column is at the same percentage as last year, which is 3.45. The third column is what I would recommend based on how I know that you like to be, where you like to come in dollar-wise, which is at 3.35%. And then I did an additional one way out, which is at the lowest, which brings you just shy of what you did last year. And I think Dana was the one that asked for that additional column in the past. So if we go with the recommended amount, which is the third column, that will take you to $222,400, which is over last year's amount of $215,000. So the city will get an increase. I'm recommending that the Marine Maintenance Trust stays at $26,000 because we've been able, in the past, we upped it a little bit, but Tim Bailey and I have been working on the DOCLA program and discovered we have several modules that we don't need. So we've worked with them to take those off, and it's gonna reduce the cost. So we're safe at keeping it at $26,000 for the Marine Maintenance Trust, which helps pays for the workers at the docks. You have the ability to keep it at the same percentage as last year, the 3.45. That will take you to $229,000 to give to the city. It's really just what you're comfortable with.
Okay, and so let me also explain for Chris that the Marine Maintenance Fund relates to a project about 15 years ago where we replaced the docks in Prescott Park. As opposed to us going out and borrowing the money or funding it with a bond or something, the former city manager recommended we set up a arrangement where the city, one arm of the city, the non-trustees, lent the money to the trustees with an agreement that we would pay it back with the net proceeds of the operating revenues from the docks itself. And if I had that other sheet, you could see how much we pay down every year.
It's about
It's-
35 to 45,000.
Yeah,
It's a net proceeds.
yes,
net
Total
revenue from the
revenues
docks.
run around 70,
Okay.
we pay back 30, 35 so that we can give some money towards the operating costs.
but we usually set, of the net, we set aside about 5,000 just to maintain in the account related to that. And whatever the balance is, we pay it to the city
Yep.
at the end of the year.
Correct.
And it will provide you at some point with a history on it. And you'll see
Next
we've been
meeting.
paying it down.
Yeah,
You know what the balance is that we owed at this?
next meeting. We're getting down there. I want to say it's 300,000 or a little less than that,
Yeah,
but
the number originally was 650,000, so. So it's really a, what's the term you call that, sort of a,
Sinking fund.
it's a sinking fund, but it's really the city's has lent money.
it was
I'm
back.
sure we wouldn't do it this way if we did it now, but because we were running the park,
Correct.
City Manager Bohenko thought that this was a better way of handling the accounting side of it. So what you're seeing here at the very bottom in the shaded blue or shaded gray includes one recommendation that we'll vote on, plus the 26,000 amount, or 26,000 amount is what Judy is projecting will be the net from the operation of the dock to pay that down as well. So from the city's perspective, the dock and the rest of the park is all part of the operating cost of the park, so. You've heard any further questions of Judy on this? Do we have a motion one way or another?
I actually have a question, Tom.
Yep.
So of this proposed 248,400, does that pay 100% of the O and M for Prescott Park, or is that
No.
a percentage of it, or?
No, not even close. So
Okay.
that's why I say,
Do we try to get to a percentage, or we just try to, it's a dollar amount based on certain criteria that we're able to do?
It's based off of the
Okay,
Yeah.
policy that the trustees have.
yeah,
thank you, that's helpful.
the cost of operating the park has gone up progressively over the years, way beyond what we
Yes,
can
right.
cover. So what we've done is, because we've been approved for a sum based on a 5-year rolling average, what we do is decide what is a conservative amount, a percentage of that rolling average, such that it won't compromise the principle of the trust. And so we don't try to maximize it out of there. It's
Calculation.
yeah, I mean, the max we could do is 4%, but we haven't done that probably since I can remember.
I've done it since I've
Certainly
been here.
since the city took over the operation, so.
And the cost, Judy, to operate the park now is 700,000?
609,771.
Thank you,
In
Nathan.
the FY 26 budget. Those revenues, folks, if I may, the Prescott 215.9 this year is significant. I mean, it's a third
Yeah, I was
of
gonna
the
say,
609.
right, yeah. Yeah.
There's also dollars that come from the city's general fund and from parking, and then there's a fair amount. There's 40,000 or more in miscellaneous revenues from rentals and the like.
Thank you.
From weddings and things like that, yeah.
And this transfer, Tom, zero interest from one arm of the city to this, the original, whatever it was,
It's
600?
just half of the amount. We give half of the amount in December and half of the amount in.
Because the Prescott Trust.
No, I meant the original loan that,
Yeah, but that's just for the
Oh.
green maintenance, so the figure you heard from
Yeah.
Nate is the total operation of the
yep,
park.
understood, yep, understood.
Yeah, there's no interest.
And the loan itself was interest-free.
Got it.
It was really
That was
an
my question,
accounting
yeah.
Yes.
function.
And just to let you know, Chris, like the Attorney General's office, like I keep an accounting of how the money's spent. We had one year where they did come in and say, can you send me a quick copy and let me see what you're actually spending the money on? So like if they see that we're spending it on something that doesn't look kosher, you know what I mean? So I'll just send them a list, so much for salary, so much, here's the expenditures, here's with it. And they were satisfied. They haven't done it since like the first year, but they're aware of this, you know, how the trustees are doing this, so.
Yeah.
Thank you, helpful.
It hasn't come up for a long time, but I can tell you that the documentation associated with the Prescott Sisters Trust is substantial. It includes a
Yes,
number
it
of
is.
lawsuits where people have gone back and asked for permission to use it for acquiring additional land or, from our perspective, it has to be related to the operation of the park. If somebody wanted to put in a statue of some sort, we couldn't approve that, so. But, okay,
Thank
any
you.
other
That's
questions?
helpful.
All right, so I guess I entertain a motion from one of you. I'm
Moved.
and is the motion to go with Judy's
Yes,
recommendation?
recommendation.
Okay. Just to be clear on that's the one that's based on
3.35%.
350, right? Okay. It's the third column over in the gray.
Right.
All right, do I hear a second to that?
Second.
Any further discussion? Okay, all in favor indicate by saying aye,
Aye.
and the chair votes aye.
Thank you.
Excellent. Okay, so we're gonna suspend these items, and we have our fund managers coming in from TD Wealth Management Group. I don't know whether they've been told that you're a new trustee, so they may look at you and say, Dana, you've grown your hairs.
5 days, 50 difference.
Good morning, everybody.
Oh, how are you?
Oh, yeah.
How are you?
Good.
Good to see you too.
Nice to see you.
John DeQuatro.
Our new trustee.
Oh,
Great to meet you,
how are
Chris.
you? Nice to meet you.
This is our finance director, Nathan Lenny.
Hello, Nathan. John DeQuatro. Pleasure to meet you.
Nice to meet you.
Peter. Great to see
How
you.
are you?
Good to see you.
Nice to see you. Where would you like us? You're sitting in different spots this time. Right in front.
Does everybody have copies of everything?
Yes, and a request, the next time, can you mail it to us? Like you do the monthly statement?
What?
Well, we can absolutely mail it to you. Mail the presentation we're going over today.
Yes.
Yeah, happy to.
My printer doesn't like to have to print out.
Yeah, I don't blame you.
Yeah, plus the cost of ink these days is outrageous. But, so as you've noticed, after 15 years, Dana has retired from service as a trustee, and
The nerve of him.
so we found a new sucker. I mean, we found so maybe you could do a little introductions of yourself, your background, for Chris's benefit, and we'll let you jump right into it.
Sure. Well, I'm Suzanne Moran. I am the relationship manager, but I'm also the nonprofit specialist for TD Wealth's institutional team, which means I get to cover the entire TD footprint, which is it's actually, I enjoy it.
Good job.
But if I'm home too long, my kids are like, don't you have someplace to be? My father used to travel a lot. We would change the furniture and see how long it took him to notice. So that's part of what I do. They haven't done that to me yet, but I'm so I work with you all on governance, reporting, things like that. But the genius here is John.
Thank you for that. I can't possibly live up to that as you all well know. John DeQuattro, I've been with TD for, it'll be 26 years this summer, all in the context of kind of investing. I used to manage the bank's balance sheet. I was running our treasury function when we partnered up with Toronto Dominion, which is where the TD comes from. I ran our commercial hedging operation for 6 years, which is mostly interest rate derivatives, swaps primarily. And then I needed to get back to what I really love to do, which is manage money. So I joined what we call TD Wealth in 2012 or 13. And I've been doing this work, and we specifically formed an institutional team in about 2015, which they asked me to be on. So Suzanne and I are part of our institutional group. All of our clients are institutions, whether it be nonprofits, municipalities. We do have a fair number of corporate clients, but they're definitely outnumbered by the foundations and endowments and trust fund type clients.
Great, well, nice to meet you both.
You too.
Thank you.
Okay,
Shall I dive in with
Take
that?
us through.
Okay. So Chris has got it on his iPad, and you've got printouts. So I'll start with this deck. And I guess I'll say a few things mostly for Chris's benefit that Tom, Peter, and Judy have heard me say many times. If you turn to page 4, it should have the pie chart on it. Chris, just let me mention before I get into the weeds here, there's 4 portfolios that we manage for you. They're all managed identically. More specifically, the holdings are all exactly the same. As a result, the returns are all nearly identical. Where they don't tie out to the basis point is simply a function of when you have distributions, the portfolios may rebalance at slightly different times. But the underlying holdings are all the same. So what I do is, on this page, if you look at the upper left, second row down, you'll see this is specifically the scholarship fund. So I'll make all my comments specific to the scholarship fund. The detail for the other 3 portfolios is in the back, and everything I say for scholarship applies to all the other portfolios. Does that make sense?
It does.
Yeah.
Thank you.
You're welcome. So on this page, let me kind of direct you to the pie chart and the table on the right, just to start with a high-level overview of the composition of the portfolio. It's comprised of 10 underlying products, and I'll show you the detail on those, I think, on the next page. But that pie chart, Chris, shades of blue are equities, and shades of yellow are fixed income. And so you can instantly just kind of see from the colors on the pie chart, the portfolio is 75% stocks, 25% bonds and cash. And then the different shades of the colors correspond to the slightly more granular detail you see in that table. So on the top right, you can see 65% is in domestic large cap. And then under that, you can see a little more granular detail. So of that 65%, 55 is large cap core, think S&P 500. We have a tactical allocation to about a 10% allocation to US large value dividend, 5% allocation to the SMID cap sector, that's small cap and mid cap, all in one holding, 5% to international developed. And then the fixed income holdings, if you go down a couple lines, it's predominantly in, about 16% in intermediate bond strategies, 5% in short bond, and I'll show you that detail. A very modest allocation to high yield, which is right in the middle of that table. It's only 2%. It's almost a placeholder. We've dialed back high yield from portfolio inception, just on expectations for potential spread widening, which interestingly just started to happen this quarter. But those are, it's a really modest allocation. Your investment policy has a 0% target for high yield, but an allowance for up to 20%. Just FYI.
In this case, is a high yield almost 1%? Is that what it is?
It's the 1.96, and so you see the
Other fixed income.
underneath that. Yeah, exactly. Yep.
Yeah.
The bank loan fund. They're those two products, bank loan and high yield, are kind of identical in composition. The main difference is the bank loan product is predominantly floating rate, and the row that says high yield is predominantly fixed rate. So you get a little bit of hedging of interest rate risk between the two.
Thank you.
Yep. And then I'll just mention, and I'll mention this a couple times, but what you don't see on here is within international, there's no emerging market exposure. As of the end of the year, we actually added some this quarter, and there's no REIT exposure, real estate investment trusts. Your IPS target is 5% for REITs. And we've been underweight REITs for the entirety of the nearly 5 years of the program. That's been positive. The underweight to international has been negative over the last year. The underweight to REITs has been positive. And I'll highlight those differences to your policy again on the next page. So if you look at the upper left, top row, total value, 15.185 million. That was the market value for scholarship at 12/31/25. So this whole report speaks to the end of the fourth quarter. In preview, it's been a pretty good start to the year. Year to date, the portfolio's up, all of them are up about 2%. Interestingly, it's been the exposure to dividend stocks and international that's provided all the return. The S&P 500 is about flat for the year. As you go down to the performance section of this page, I'll just highlight it, and I'm going to come back to this in a couple pages, but just while we're here, inception, so the portfolio since inception, just over 8%. Year to date would be all of 2025, just under 15%. These are net of fees. And Chris, your fees are 0.2% all in. So 20 basis points are the all-in costs. So almost 15% last year. This was the third really strong year in a row. Again, predominantly driven by equity returns, although I'll show you on the next page, fixed income had surprisingly strong returns last year. 2024, your total return was 16%. 2023, your total return was 19%. So your trailing 3-year return is now 16.5%. So it's been a really nice stretch. And TD remains constructive on equity markets going forward. So we expect, I think we'd be surprised if the S&P 500 was up another 16% this year based on last year's performance, but we wouldn't be surprised to see double-digit returns.
What's the benchmark? Is that just?
That is a system default benchmark that has nothing to do with your IPS or your specific policy. It's what the system does is for any portfolio that's between 69% and almost 80% stocks, it assigns this specific benchmark. And on the equity side, it's 60% S&P 500, 15% international. So there's no exposure to emerging market, there's no exposure to small cap or mid cap in that benchmark. And what I'll show you, Chris, in a couple of pages is we have a custom benchmark built into the system. It doesn't reflect on this page, but what it does is it aligns to the targets in your IPS. So you can see, okay, if we followed precisely your IPS, what would the return be versus what the portfolio is.
And that's the benchmark we use in the monthly dashboard report that we sent.
Have you seen that report, Chris? The
Yeah,
monthly
he
dashboard?
got a
It was in
copy
here
of
that
it.
I got
Yeah.
it, yeah.
Yeah, that one, which you'll see each month, specifically compares the portfolio performance to your benchmark.
So the benchmark was
Policy
a prediction,
benchmark.
numerical prediction, and the investment to the left is actual in terms of the performance of how we did.
Almost. The investment is your actual performance. The benchmark is
Calculation based on.
based on a set of underlying holdings which may or may not mirror.
That's helpful. Yeah, thank you.
And then just lastly, on this section, the 2.27% performance in the fourth quarter was another good quarter. If you remember 2025, the only negative quarter was Q1. And the news item that kind of triggered the sell-off in stocks was, I won't expect you to remember this, but in early March or late Feb, a Chinese AI company released a model that they claimed used a fraction of the chips that the ChatGPTs of the world are using in their models. And the market kind of freaked out and thought, oh my God, NVIDIA, which has been one of the best performing stocks in the market, demand for them is going to fall, and so at one point the S&P and then that was followed shortly by all of the confusion surrounding the tariff announcements. And so within the first week of April, the S&P 500 was down 19%, but it started in the first quarter, and then we had a dramatic recovery since then. I'll show you the quarterly performance for the year in a couple pages, but with the Q2 and Q3 were actually stronger than the 2.25 you see here for Q4, but another good quarter. Right down below that where you see the unrealized gains, so it doesn't show you your net number here, it shows you unrealized gains and unrealized losses. And so if you just look at that top row, 4.1 million in gains, 162,000 in losses, all of the unrealized losses are in your bond holdings. And I wouldn't expect you to remember this, but 2022 was the worst. So we built this portfolio in 2021. And then within the next 16 months, we experienced the worst performance for the bond markets. Don't ask me to fact check this, but supposedly since the late 1700s. It was like 1788 was the last year that bond performance was so bad. And everybody's heard me say this ad nauseum, but I'll remind you, bond prices move inversely to interest rates. So when interest rates rise, the value of your bonds goes down. When interest rates fall, the value of your bonds go up. In 2022, the Fed took interest rates from, it basically rounded to 0 up to north of 5%. It was about the quickest increase that we've seen, and certainly in our careers. And so your fixed income holdings, which is largely a 1 to 10 year portfolio of bonds, is still recovering from that. I would expect by the end of 2025, if rates hold steady and equity markets, stay even flat or better, you'll see most of those losses disappear.
And would you say the net is both of those combined?
It is, yes. So your net is almost 4 million in gains. Yeah, all in equities. With that, I already haven't gotten into too much detail on you. Let me ask you.
Oh, it's because of me.
No. No, it's because I'm an investment geek, is what it is. If you turn to page 6, and I'll spend some time just kind of describing. I know there's a lot of data on this page. So on the far left, what you're seeing is, and it starts at the top of the Fidelity 500 index. Each of these line items represents a holding in your portfolio. And what I meant to mention when we were looking at the pie chart and I was just describing the overall portfolio is per the preferences within your investment policy, which actually aligns with my preferences, you seek a portfolio comprised of passively managed products. And so none of these products involve paying somebody to come in every day and decide if you should own Coke or Pepsi or Microsoft or Apple. These are all passive exposures to the broad market indices. Now, this has served you well. Your portfolio is one of the best performing portfolios that I have in my book. And a big reason for that is passive continues to outperform active by a wide margin. The most recent statistics I saw, which were through 2024, it was something like 85% of active U.S. large cap managers underperform the S&P 500. I mean, it's really astounding. And equally astounding, I would say, is I have yet to see what I would consider a really kind of robust analysis of why that is. Traditionally, you'd hear reasons such as, oh, the U.S. market is so efficient, you really can't gain much of an advantage. There's hundreds of analysts that cover the Cokes and the Microsofts and the Apples, and nobody can really gain a meaningful advantage in analyzing those companies. I don't know how true that is. The second reason you'd hear is fees. Active managers charge higher fees. The just as an example, if I were to put you in an actively managed domestic large cap manager, somebody who's coming in every day and trying to beat the S&P 500, their fees, which we would pass on to you, would be somewhere between 30 and 40 basis points. The internal expense ratio of this Fidelity 500 ETF is 1 basis point. So, every day the manager comes in and he's like 30 basis points behind the market just based on fees. And then lastly, and I would tell you, in my opinion, this is probably the most important reason, but like I said, I just haven't seen, it's hard to get the data, I think is the biggest thing. But most money going into the stock market right now is going into passive strategies. And it's largely it's new money going in. I can almost assure you that, my kids' generation and the 20 to 30-year-olds of the world probably will never invest in an active strategy. So all that new money is going into passive. And then within, shops like us, you'll increasingly see clients say, why do I keep underperforming with this active manager? Let's go passive. And so when that happens, they're selling all the stocks that the active manager owns and they're buying the index. Well, and one more point here, and I'll try to get out of the swamp. The S&P 500 is not equally weighted across 500 companies. It's weighted by size. And so when you put $1 into the S&P 500, roughly 8 cents goes to Apple, 7.5 cents goes to Microsoft, 7 cents goes to Google, 7 cents goes to Amazon. Like the top 10 stocks are about 35% of the index. So as money keeps flowing into the S&P 500, these big companies, they just keep getting bigger and bigger and bigger and bigger. We now have multiple trillion plus market cap companies now. And so no active manager, or it's extremely rare that an active manager would hold 8% in any one name. Most of them are restricted to holding a max of 5% in any one name. And more commonly, I would say you see like their biggest holding might be 3%. Your IPS doesn't do that, but we have a lot of client investment policy statements that similarly restrict, maximum allocation to any one company, 5%. And so by definition, if most of the money is going into the S&P 500 and the biggest keep getting bigger, if you don't own 8% Apple, 8% Google, 8% Amazon, 3% Nvidia, you're almost doomed to underperform the market in this environment. So forgive that really long-winded explanation, but I think it's important because your portfolio is designed to like, in a best case scenario, you're going to perfectly match the index, right? Because that's what we're trying to expose you to. And it's been the best performing strategy for
So you're saying
many
set it and
years
forget
now.
it, more or less, is that?
Basically,
yes and no.
except we will make
Tweaks, make course corrections?
two
On the
things.
asset allocation.
We'll make tactical adjustments based on TD's views of the market. And the S&P 500 index itself isn't static. Companies get added to it and subtracted from it. So I wouldn't call it set it and forget it. It's more an acknowledgement that if you can match the market's returns, it's the best strategy in today's environment.
And a follow-up, if I could. And how often do you make corrections? Is it quarterly? Is it?
Yep, the portfolio rebalances quarterly.
Thank you.
Tactical changes could be, 0 per year or probably no more than 3 or 4 per year.
Okay, thank you.
And
That's
they're
helpful.
always
That's
in the context of
Yeah.
your investment policy statement, which we need to stay on sides.
Thank you.
You're welcome. So getting back to the detail on this page, everything going down the left side is an actual holding in your portfolio. You got the S&P 500 on the top row, the next row, and you see the percentage allocation to it in the second column. 10% to Russell 1000 value, those are all dividend paying stocks. Your international exposure is the third row down via the MSCI EFA index. Then, I'm sorry, this is in this order. I can't change the order of this report from what the system defaults, but then you get into the fixed income holdings, but the first one's that floating rate high yield product at 1%. Then you get into 2 US Treasury strategies, and they're all sorted by duration. So you've got 1 7 to 10 year, 1 3 to 7 year, and then 2 rows below that a 1 to 3 year. So I've built you basically a 1 to 10 year US government bond ladder, if you will, through those products. And then above the 1 to 3 year, you see your investment grade corporate bond exposure. And then high yield is second from the bottom. That's the fixed rate product. And then your small and mid cap exposure is at the very bottom there at 5%. In the middle of the page, you see the style. Similar to what I just described, large cap core is the S&P 500, et cetera. And then in the second column from the right, you see the quarterly performance. And so what I point out to you here is you see the S&P 500 at the top, 2.64%, another strong quarter. And if you go to the far right, you can see the 2025 performance of just over 17%, a good year. Value outperformed the S&P 500 in the fourth quarter. It happened twice last year, once in the first quarter when we had that sell-off, and then again a little more than modestly in the fourth quarter. It has been significantly more dramatic year to date. So what are we, month and a half into the new year? The S&P 500's flat. This value strategy is up 6%. And interestingly, you don't have large cap growth exposure. It's down 4% year to date. So value is outperforming growth by 1,000 basis points year to date. Now it's a short sample, but that would represent a pretty meaningful rotation if that continues.
What's the bank loan?
Bank loan is a somewhat confusingly named high yield bond product. It's comprised, they call it bank loan because it's a securitized version of the type of commercial loans that banks hold. If you are an investment grade company, if you're Coca-Cola, if you're Ford Motor Company, you tend not to borrow money from banks. It's cheaper for you to go out and sell bonds to the general public. You've got a high investment grade rating, and you can do that at a very modest spread these days to treasuries. If you are a below investment grade company, there is a capital market system for you, which is what you see here. But historically, those were the companies that would go to a bank and borrow money. Banks very much prefer to loan money on a floating rate basis because it gives them a better match for their funding. CD rates go up and down, bank deposit rates go up and down. So banks prefer to loan on a floating rate basis. So they decided to call it the securitized version of those loans a bank loan product.
Is that public or private?
Public. Yeah, you could go buy this exact fund in your Fidelity account or whatever if you wanted to. Yep.
So like the New Hampshire Turnpike, for example, puts out bonds. This could be a municipality like a.
There could be a very small portion of below investment grade muni bonds in here, but it's mostly going to be taxable. These are mostly
it is public though. It's a public
corporations.
entity.
Yes.
Okay. Wow.
Yeah. And just while we're on it, you can see for the quarter the returns were just over 1%,
Yep.
and for the year 6.25%. Yeah, and then contrast that to the second row from the bottom, which is the fixed rate high yield bucket. It was your best performing fixed income class for the year at over 8.5%, and then 1.25%. What we are seeing now in preview is we're starting to see the markets get a little, with this sell-off in the tech stocks year to date, the markets are getting a little nervous about credit quality in the lower rated segment of the market. And so you've started to see credit spreads widen, which is equivalent to an interest rate increase on these products. So that bank loan product's actually down about 0.5% year to date, which is exactly why you have a very modest allocation to it. That's kind of the event that we've been waiting for, which is why we've been a little underweight high yield, even though it has been a strong performer over the past year.
What is AI? How does AI affect any of this at all.
That is the
I know we don't have that much
$64
time.
trillion question.
You can
Exactly.
answer that question.
Yeah, exactly.
Yeah, and the market's treating it as almost binary right now. One day it's AI is going to save the planet, and all of the growth right now is going into these data centers and the computer chips, and this is where much of the growth of the U.S. economy is coming from.
Right.
And then the next day, AI is going to destroy the world and every white collar job, and a 15-second video came out this week of it was like an action movie scene. It was Tom Cruise tackling Brad Pitt on a rooftop, and it was 15 seconds long, and it scared the you-know-what out of every writer and actor in Hollywood because it was 100% AI generated.
And it looked totally real.
Yeah, you couldn't tell the difference.
That was
And-
the next Top Gun, right?
Yeah.
Yeah, and so one day it's going to save the planet, and the next day it's going to take every job. One of the Microsoft AI chiefs was quoted in an interview last week saying that in his mind, within the next 18 to 24 months, AI will be capable of doing virtually every white-collar office job that you can think of, an accountant, for example. Or a finance manager, right? Just taking the data and building spreadsheets.
Handsets for civil engineers, right? How we design bridges and, attorneys, their boilerplate stuff. So all of that stuff, we're seeing it, work that we do from an
Yeah.
engineering perspective. So yeah, I mean, it's,
Yeah, it's both incredibly exciting and a bit scary all at the same time. And the scariness is compounded by the fact that in many cases, the developers of the models don't entirely understand how they work. And like machine learning and how they're doing what they're doing. It's just an unbelievable environment. All that said,
sorry for the question.
no, I appreciate all the questions, and
Tom, you can tell me to stop at any time.
It's scaring me now.
it's a strong driver of U.S. growth right now. Last year, and I'll remind you, going into last year, there were a fair number of folks who expected a recession last year. TD was never in the recession camp, but we kept lowering our GDP forecast throughout the year, and then it ended up surprising on the upside. And much of that's attributed to the investment that's going into AI, and we don't expect that to slow down in 2025. So, the one thing I want to say here, because it's relevant to the next page, or the only other thing I want to say here is, if you look at the third row down, which is your international exposure, 4.5% in the fourth quarter. It was your best performing holding.
31%.
And then almost 31% for the year. And it was absolutely your best performing product for the year. If I could go back in time and make one change to the portfolio, it would be
More of that.
we're underweight international relative to both that benchmark you asked me about on the first page and the, more importantly, to your IPS. And TD has been underweight international because the US is simply just growing meaningfully faster. What we got wrong last year was the US dollar depreciated by 10%. And it appears largely to have been an unexpected reaction to what we didn't anticipate was the very aggressive manner in which the tariffs were announced. And you saw a pretty dramatic, to the extent that investors in foreign countries could do it, they dialed back their purchases of U.S. Treasury bonds, which decreased demand for the dollar, which caused about a 10% depreciation in the dollar. So if you compare that 31% to the 17% performance of the S&P 500, it's not that international markets outgrew the U.S., in fact, they grew less than the U.S., but when you convert those foreign earnings into U.S. dollars on a weaker dollar currency basis, it's like a kicker effect on the international earnings. The one change we made to the portfolio going into this year, you won't see it until we do the Q1 review, is we increased your international allocation by 7% and took it away from the S&P 500, the domestic stocks. So we're now more closely aligned with your target, and it was based on the fact that we expect another 3 to 5% depreciation in the dollar this year. And so just didn't want you to have that drag. We'll see how that plays out. Foreign currency transactions are exceptionally difficult to forecast. That said, our president most recently, he is calling for lower rates, which tends to contribute to a lower FX foreign exchange rate. And he publicly says he likes a weak dollar. The rationale for that would be it makes our products less expensive in international markets. Conversely, our Treasury Secretary, Bessent, said, no, we're still maintaining a strong dollar policy. So the Treasury Secretary always says that, so I would put more credence in the president's remarks, hence the slight tactical change. With that, if you turn, any questions on that, Chris? That's a lot of detail on the
No, that's
portfolio.
good. Thanks for,
At the end of the day, it's comprised of these 10 products, and you got the equity and fixed income exposure.
John, we're gonna have a hard stop because we have another group coming in at 9, so if you could keep it rolling here.
Consider it done.
I have some questions.
I will not make you late. Yep. Chris, this is all your fault, by the way.
you're here.
Just kidding. Once I start talking, Tom knows he needs to shut me off. Lastly in this deck is page 8. And this is just high-level performance. So what I want you to focus on is on the far left are the periods. So at the top, you see Q4 2025. You see the same 2.27% net of fees that I showed you on the first page. And what I want you to compare this to is the third line down that says COP IPS, that's City of Portsmouth IPS. So that 2.34% is if your holdings were perfectly aligned with the targets in your investment policy, which for this discussion, think the only real difference would have been more allocation to international. You had no fees in the portfolio, you would have returned 2.34%. In the fourth quarter, your portfolio was 2.27. In terms of my work, that's pretty much on par because you got fees coming out of your portfolio. However, if you look down to the trailing 1 year numbers, that you can see that drag is virtually all associated with the underweight to international. The other part is mid-cap stocks dramatically underperformed the S&P 500 last year. And both your policy and the portfolio have about a 5% allocation to mid-cap. But the majority of that is from international. And then at the very bottom, if you look at the custom period, that's from inception. And you'll see the portfolio up 8.25 versus 7.77 for your IPS. That is because up until last year, domestic outperformed international. So you were getting a big lift from it, and we gave a bunch of that back last year and over 2026. I don't expect to see nearly as big a difference. So I think we'll probably hold on to that advantage, and then we'll see what tactical changes TD makes going forward. But from inception, you're beating your portfolio by almost 50 basis points, but we gave a bunch of that, that was a much higher number going into 2025, excuse me. Does that make sense, Chris? With that, really quickly, I'm going to take you through this deck. And there's just, and I do mean quickly, I won't even go through every page here, but just the quote at the beginning on page, page 3, this quote, is salient. It really kind of echoes thoughts I've made. So going into this year, we think there's 3 tailwinds to growth. The Big Beautiful Bill, simply because you've got tax benefit for part of the population, which we're already seeing express itself in consumer spending. More dramatically, the boost in business investment because of accelerated depreciation. Definitely regulatory reform, for better or worse. We've virtually gotten rid of the Consumer Financial Protection Bureau. And then, as we talked about, the continued investments going into AI. And so we're looking for over 2% real growth this year. And so real meaning you take nominal growth and subtract inflation, which we think will be about 2.5. So, maybe about 4%, 4 to 5% nominal growth and just over 2% real growth. So looks like a good year. If you turn to page 4, this is just showing you index returns over the last quarter and then 1, 3, 5 year. All I want to point out to you on this page is on the very top row, which is the bonds. In the 1-year column, you can see 7.3% for the aggregate bond index. We do not live in a 7% interest rate world. We live in like a 3.5 to 4.5% world. The reason you see 7% here is because interest rates fell last year. And so the price of bonds goes up when interest rates fall. You benefited from that as well. In the next block, equity returns, if you look at the 3-month, which is the second column from the left, U.S. large cap growth, 1.1% in the fourth quarter. U.S. large cap value, 3.8. First time in a while we saw value outperform growth, and it's continued into this year, as I mentioned. It's 1,000 basis point outperformance year to date. And then right below that is the strong international performance that we talked about. Page 5, all I wanted to point out to you here is this, we call this one of many periodic tables, right? It may, for better or worse, remind you of chemistry class back in high school. Yep. But what it does is it takes the indices at a high level and just charts them in order by performance. And so if you look at the second column from the right, that's calendar year 2025. And no surprise, as we've discussed, international, whether emerging markets or developed international, were the strongest. What I really want to point out to you here is REITs were at the very bottom. Your portfolio interest, your IPS is unique among my clients in having a specific target allocation to REITs. I didn't create your portfolio and I wasn't working with you when you created it, so I can't tell you precisely what the thinking was, but my guess is that REITs are required to pay all of their, or 95% of their income to their investors in the form of dividends. And for many of your sub-accounts, you can only spend the income. And from roughly 2007 to 2022, interest rates were close to 0. And so REITs were a way to generate income via the equity market where you couldn't get it in the fixed income market. We haven't held any REITs for the duration of this portfolio because real estate has been so challenged since COVID. Mm-hmm. There will be a time to get back into REITs. We probably won't know that time until, it's 6 to 12 months later, but I do expect to hold REITs in the portfolio again someday. But you can see, just as you look at this chart, how, since 2020, 2020 REITs were at the very bottom. And as you go across, that light gray bucket has underperformed. So one of the better tactical allocations has just been overweighting the S&P 500 relative to REITs. And lastly, I'm just going to go to the last page. Well, let me ask you to turn to page 8, just so I can graphically show you. This is interest rates. And so what these two lines are showing you is, if you look at the x-axis on the bottom, you see 1 month, 1M is 1 month, out to 30 years on the right, and then the y-axis is the yield. So this is just the U.S. government yield curve. And so the end of 2025 is the green line. And so you can kind of quickly see, short-term rates are about 3.5%, 2-year rates about 3.5%, 10 years about 4.2%. We call this a positively sloped yield curve. We actually haven't lived in this is what people consider normal. We haven't lived in this environment for a really long time because the Fed took interest rates up to, 5%, and the rest of the market really priced in the rates coming down much sooner than they did. And so now the Fed has now taken rates between 2024 and 2025 from 5.5 down to 3.5 on the short end. That's why you saw those big returns on your bonds, because we got almost a 1% decrease in interest rates. The bad news is in the bond land. When you have a maturity, now you're forced to reinvest at a lower rate because rates have fallen. So there's no, the expression is there's no free lunch in finance. There's definitely no free lunch in fixed income. But with that, if you turn to the very last page, page 11, I just want to show you our rate forecast. The very top row is our forecast for the Fed funds rate. We are now, 4 rows from the right, you can see 2026. We're now at 375 for the Fed funds rate. We expect one cut of 25 basis points in the next quarter, and then one more cut in the third quarter, and then they're gonna hold. So we think we see rates go down by 50 basis points to 3.25 for Fed funds. We think we maintain a positively sloped curve. Chris, don't go out into the wagering markets and place any bets on this rate forecast. You got to get 3 things right to outsmart the fixed income market. You got to get the direction of rates right, you got to get the timing right, and you got to get the magnitude of the change right. And I've been staring at screens for 30 years. I have yet to meet anybody who can get one of those variables right. Even the Federal Reserve that sets this rate, their own forecasts tend not to play out. They're always reacting to what's going on in the economy. That said, this is pretty much a consensus forecast. It's in line with what the Fed's telling you. And I go to bed every night praying that short-term rates don't fall below 3%. It's just, as somebody who's trying to, build portfolios for clients, to throw off income, to meet trust fund requirements and support the municipality, when fixed income rates go, down to 1, it's just very hard to do. Yep. And then just lastly, at the bottom, you see our GDP forecast. I mentioned just over 2.2% for the year. And then below that, 4.2% unemployment. So we continue to forecast a healthy employment market despite, the scary aspects of AI. And then CPI, interestingly, the most recent statistics came in closer to 2%. That was a bit of a surprise on the low side. Fuel prices were a big component of that. But we are forecasting that inflation is going to be closer to 3% than the Fed's 2% target. And so if that plays out, you may see the Fed drag their feet a little bit on lowering rates throughout the course of the year.
John, I have one question for you, because I know we're on a time restraint. Do you ever consider, we've been with you 5 years now, or will be.
Almost 5, yeah.
Doing a 3-year extension in exchange for reducing your fee?
Well, I'm happy to say that we make those decisions via a committee that I don't have a vote on, but which I will gladly present a request to. So it's something that we will certainly consider.
Okay.
That came out of the blue. Let me ask you, John, the usual questions I'll ask, which are, you're familiar with our investment policy statement, including our allocation between equity and debt. Do you have any thoughts or recommendations as to whether we should stay the course or adjust the policy in any way?
Yeah, the recommendation would be to stay the course, at least based on our 12 months forecast. We are within our internal models. We are slightly overweight equities. If you're overweight something, you have to be underweight something. So we're slightly underweight fixed income. I do mean slightly. It's like a 2%, overweight in our models. But that overweight is based on us continuing to be constructive on stocks. So, and given your history of distributions from the account which are relatively modest, as long as you can withstand the volatility that comes with a 75% allocation to stocks, history has shown time and time again that it will serve you well. So, no recommended changes.
Okay. Any tactical moves?
Just the ones that I referenced, which you'll be able to see on paper next quarter, which was reducing the underweight to international.
Okay. And final one, you might not have these now, but have you looked at our performance of our peer group?
Meaning the data that I give you from the the charitable, the New
Yeah,
Hampshire Charitable
the
Foundation.
New Hampshire, the main charitable,
I haven't seen that data most recently. Would you like me to do that analysis again at this time?
yeah, if you could run it based on year-end figures.
Yeah, I'm happy to. My best guess is that you will have again outperformed. It's not, Chris, for your benefit, it's not even remotely an apples to apples comparison because these much larger foundational accounts have a meaningful exposure to the private markets, pure hedge fund strategies, and private equity. And those have underperformed the broad US market for like 4 years in a row now, I think. So you benefit from that, but I will put that together for you.
That would be great.
So is your question, Tom, so looking at like the city of Portland, for example, if they had a similar, how are we, is that more the basis of your question?
Well,
So-
yes, but a lot of that information's not available
Right,
generally public, so, but I know the TD Wealth Group has other municipalities and
Yeah, and I can't give you that data, but I can tell you anecdotally, your portfolio is the highest performing for two reasons. One, you're 100% passive, which has been the best strategy from an active versus passive.
why wouldn't you just do it if it shows that passive is better than active? Why wouldn't you just do that? Why wouldn't the other municipalities just do that?
One reason would be if you have a policy constraint of a max exposure to any one name, the S&P 500 will put you over it
Okay,
Yeah, the
because it's weighted by
Magnificent Seven will
size.
interesting.
fill that in.
we'll
And-
provide you with a copy of our investment thing. In fact, Judy, can you send Chris a copy of our investment?
I certainly
Policy,
can,
because-
yes.
We usually ask John and Suzanne their thoughts on that. We see them every quarter. But part of our thing is to look at that at least annually on a serious basis. And every municipality does the same thing. And there are some who have, there are some who will do no more than like a 65-35 equity.
Just your regular.
The bond.
I appreciate your question, though, those are ones I was thinking, so.
Okay.
One quick question,
Sure.
housekeeping wise.
January.
We have
Yeah.
Dana Levinson as the contact point for the statements.
Yeah, so
Change
you'll
that.
get Chris's new information, if you could send him one of your things that you send Peter and I directly.
Okay.
That's what John just asked.
Oh.
So,
We were whispering in it.
yeah.
Thank you both for coming in, we really appreciate it.
Our pleasure
Thank
as
you.
always. Thanks for having us.
Thanks for indulging all my questions.
Always.
Of course.
Yeah, not just today.
Yeah, we're available.
All right, is there anything that we need to do?
I
Can
can,
you hold the fort off?
well, I'm gonna have, yeah, I can hold the fort on the second, the last two items on there. Checks, but can we sign them?
Safe
Bye,
travels.
thank you.
Thank you.
Can we sign checks in the chambers?
Yeah, we'll sign the checks later, but in terms of what's left on the agenda, do you need?
Library trust disbursements I can hold.
Okay, can we quickly do the CD, because we've got to move that one CD?
Yes,
Just blame me.
yep.
Minute? Yep.
Yeah, thank you.
All right, so the quick thing is that, we had two $250,000 CDs that came up for renewal. One of them, and because we didn't meet in January, we couldn't do this exercise at that time. We had, one of the CDs was with TD, and they significantly dropped their CD rates. And the other was with Newbury Port Savings. That one actually came up for renewal
First,
back on
January.
January 23rd or 24th or something. Its rate was pretty close to what it was before. So we allowed that one to roll over
Into a 5-month.
into a 5-month one, so we'll have a chance to come back and look at that. You can see the rate on that is pretty favorable to,
Yeah, 3.6.
but, they don't have the 10-day period that you have with a retail customer to to pull money out, so because we were facing the deadline, I authorized
To close it.
Judy to essentially close that CD, and those funds are ready to put in another CD today.
And I don't have a problem with that, but it would be good to do an email vote just because I don't think one trustee has.
I completely agree. The problem is that literally it came up that day.
They notified me, oh, by the way, we don't have a 10-day window. And what are you doing with this
We thought we
today?
were gonna be within
was
the
like, oh.
10-day window today.
Yeah,
And so literally the money is out of the CD for 6 days or something like that. But I think we need today to decide where we're gonna put that.
Yeah.
And then, hopefully we won't have this issue again now that everybody lives here.
my recommendation would be to go with Eastern Bank at 3.75, using the city of Portsmouth. We have a great contact there. That's the rate that she's offered us for 6 months. It's also, the highest rate that we've been offered. So that would be my recommendation.
Does anybody have any questions, or would someone make a motion to that effect?
So moved.
Second.
Second, any further discussion? Hearing none, I'll call the question. All in favor indicate by saying aye.
Aye.
And the chair votes aye.
Great. Thank you.
All right. So we'll get out of here. The library one can wait till next time, and we'll just go over and sign your checks.
Yep. I think Nathan's gonna, Nathan, can you join the guys for a couple of minutes in the chambers? Okay.